Concepts of capital structure. Just like the structure of a room is determined in terms of its proportion of length, breadth, and height, the structure of capital of business enterprises is determined through the proportion of debt and equity used in its makeup. Capital structure refers to the mix between owners and borrowed funds. In simple words, it refers to the debt to equity ratio. It is computed as debt divided by equity or debt divided by debt plus equity. On the basis of ownership, the capital of a firm can be primarily classified into two sources, namely owned sources and borrowed sources. The owner's fund can be raised through equity share capital, preference share capital, and reserves and surpluses or retained earnings, whereas borrowed funds can be raised in the form of bonds, loans from banks and other financial institutions, debentures, public deposits, etc. In order to make financial management effective, it is important to decide the proportion of each source prudently. This makeup or composition of capital of a business enterprise is known as its capital structure. Capital structure of a business affects both profitability and the financial risk. This is because with the use of higher amount of debt, the cost of funds may reduce, leading to higher profitability, but at the same time, issue of more debt increases the financial risk of a business. Capital structure will be said to be optimal when the ratio of debt and equity is such that it leads to an increase in the value of the equity share, thereby increasing the wealth of the shareholders. Meaning of financial leverages. The term leverages in literal sense means something used to take advantage of. When used to the context of financial management, the term leverage refers to a financial ratio which indicates the proportion of debt in the total capital of the enterprise. In simple words, the proportion of debt in the overall capital is called the financial leverage. Financial leverage is equal to debt divided by equity. It is computed as debt divided by equity or debt divided by debt plus equity when D is the debt and E is the equity. Financial leverage is an important concept in financial management. In fact, it is one of the key factors in capital structure decisions. Financial leverage can be broadly classified into types, namely high financial leverage and low financial leverage. In a nutshell, a company is said to be highly levered when the proportion of debt in the total capital is high, whereas when the proportion of debt in the total capital is less, then the company will be said to low levered. As the financial leverage in business increases, the cost of raising funds decreases because of increased use of cheaper debt, but at the same time, financial risk increases. The effect of financial leverage on the financial health of an enterprise may be broadly studied into categories: favorable financial leverage and unfavorable financial leverages. When the return on investment exceeds the rate of interest, the financial leverages is favorable, or the firm is said to be trading on equity. It also reflects that there is a financial leverages is favorable. Its advantages is passed on to the equity shareholders in terms of higher returns. Whereas when the return on investment is less than the rate of interest, the financial leverages is unfavorable. Consequently, the equity stockholders are not benefited from the use of debt in capital structure. In order to understand the concept of trading on equity, we need to first appreciate certain facts as listed below. Debt is a relatively cheaper source of finance as compared to equity. The amount of interest paid on debt capital is treated as tax deductible expenses. The debenture holders do not enjoy voting rights, so the control of the equity shareholders is not diluted.